excellent introduction, so there's not much else for me to say, but my name is Carley Garner. I am a futures and options broker at Carley Trading. We offer everything from full service trading to discount online trading, and yes, we absolutely do offer Jigsaw to our clients. We'll talk a little bit more about that in a minute. If you're on social media, you can check us out on Twitter. My handle is @CarleyGarner. We're also on Facebook or Instagram. If you just search Carley Trading, we should come up. And also, if you're interested in learning a little bit more about some of the things that we do, some of our services as far as brokerage, and if you just want to learn a little more about some strategies, whether it's day trading or anything else, you can take a peek at our website. It's decarleytrading.com. We've already talked about my contributions to Mad Money, which is always a lot of fun, but I also I write our monthly column for Stocks and Commodities magazine, but more importantly, I write 2 newsletters for DeCarley brokerage clients, the Financial Futures Report and the DeCarley Perspective. We put out pretty specific market research and ideas and that sort of thing. You can sign up for a trial on our website if you're interested. And my latest book is Higher Probability Commodity Trading. It's available at any major outlet, but it's cheapest on Amazon, and especially I know a lot of you are overseas, or I should say not in the U.S. Maybe I'm overseas and you guys are not. Depends on how you look at it. But either way, Amazon's really the best way. They just have great logistics when it comes to shipping and that sort of thing. So anyway, let's get started. Of course, there is substantial risk of loss in trading futures and options, although we're going to give you a couple ideas on how to hedge that risk. That doesn't mean that there's no risk. Obviously, we're speculating, we're not investing, there's risk. All right, so there's basically 3 ways that day traders can go about speculating in the markets. They could either buy or sell a futures contract, which I'm sure most of you are very aware, and probably do it quite often using Jigsaw, or with the help of Jigsaw, I should say. The other thing would be to either buy or sell a futures contract and then purchase a call or put for protection, and we're going to go over some examples of that. The third is to simply buy an option, but today we're going to focus on actually trading the futures contract and then using an option to hedge it. Now, in theory, you could hedge your futures position with either a long option or a short option. Today, we're just going to focus on a long option, but just keep in mind, the thing about option trading is you can be creative, and there's no limit to how you can hedge a position. Trust me, you can choose different strike prices, different months. It gets pretty hectic, but we're going to show you a couple examples and hopefully give you some ideas. The idea of using options is it gives you lasting power, and it has the ability, if your trade is constructed right, to provide limited risk without the potential for premature stop outs. So before we really get into the nuts and bolts of what we're talking about today, I just want to kind of explain what we can offer at DeCarley using Jigsaw. Jigsaw is compatible with our most popular platform. It's the Zaner 360. That's what we call it, but it's also, some people might know it as Gain Capital's platform, the Gain Trader or the OEC Trader. It's all really the same thing. So you would be able to use Jigsaw with our most popular free platform. The great thing about this type of a setup is it enables traders to trade futures and options side by side, and that is not available in all platforms. Most day trading platforms don't offer option trading. It's strictly futures, and don't get me wrong, they do a good job of that sort of thing, but it's really nice to have the ability to trade options. Even if day trading futures is your primary strategy and you're only trading options occasionally, it's really a pain in the butt to do it in a different account or a different platform. If you can do it all in the same place, it makes things far more convenient. And it also gives you the ability to take advantage of portfolio margining. If you're trading your option and your future in different accounts, for example, let's say you're buying your futures contract in your futures account, but then you're buying an option to protect it, a put option in a different account, you're not getting the margin break that you would get if you were doing it in the same account. So the whole point of today's presentation is do not be afraid to be different. Most traders migrate to what's comfortable. Day traders tend to stick to trading futures contracts and then placing stop-loss orders for risk management. I'd venture to say that most of the people in this class are doing just that, and I'm not saying that that's wrong. I'm not saying one's right and one's wrong. It's just different. It's always nice to have a different perspective and keep in mind different strategies. Explore your options. Every market situation is different. Sometimes stop orders are most appropriate. Maybe sometimes options are. But at least if you have the information, you'll have a choice. And I always emphasize to traders, what is comfortable and common isn't always the most efficient. Just because everybody has always done it a certain way doesn't mean that that's the only way, and that's not even the best way to do it. Sometimes thinking outside of the box can be extremely beneficial. So day traders generally assume the best method of risk management is through a stop-loss order. I question whether this is true, but every book you read or every course you take, somebody's going to have a different opinion, and I would venture to say that 95% of the literature out there will tell you always use stops no matter what. But there's different perspectives and different ways to look at anything. But I can tell you, anybody that has been stopped out of a trade just before the market turns in the desired direction might have a different opinion. It's probably happened to all of you. I know it's happened to me. It's part of trading. So with that in mind, in my view, stop-loss orders often do more harm to a trading account than good. It's kind of like Murphy's Law. Traders are frequently stopped out at the market highs and lows, causing the maximum pain, especially in a market like today where we're seeing 20, 30, heck, even 100 handle moves in the S&P. Things can get hairy. And if you have a stop order in, chances are you're probably going to get triggered on that stop before the market moves the way you want it to. And this can be really, really frustrating. I don't have to tell you that, and what happens is it leads to poor decision making and emotional trading, and that is extremely counterproductive. So the advantages of stop-loss orders are pretty obvious. They reduce the risk of a runaway trade. You can get up from your computer and go get a cup of coffee without coming back to a bloody trading screen. You know what the worst case scenario is. Assuming that you're ignoring slippage, we do know slippage is possible in some cases. But with the electronic markets, it's not nearly as prevalent as it used to be. And stop orders mitigate the emotional duress that are caused by decision making on when to pull the plug on a bad trade. If you're not using a stop, sometimes it's hard to know when is when and how much is too much. Even if you have a mental stop, it doesn't always work out that way. We're human. The biggest disadvantage of a stop-loss order is the finite nature of trade exit. Once a trade's stopped out, it's impossible to recover, even if the market does, and it often does. Getting back into a market after being stopped out is generally a bad idea. Yet again, we're human, and it's human nature. When we're stopped out of a trade, the first thing we want to do is just get right back in, place another stop, and I see it day in and day out. I've speak to people that do that on a habitual basis. More often than not, it does not end the way that you want it to. And also, if you're playing this game of getting stopped out and getting back in and then getting stopped out again, it's destructive, leads to poor decision making, and it leads to vengeance trading, which rarely works out. So the question is, should traders use stops? You've probably guessed that stops maybe aren't my favorite way to go about it, but again, everybody has a different idea. The great thing about trading is There isn't a right or wrong way to do anything. It is what works best for your situation, whether it's your risk tolerance, your account size, your emotional stability, your personality, those sorts of things. So the bottom line is do what feels right and what you're comfortable with. That way you're ensuring that you're hopefully keeping a level head and making good decisions. Once you ruffle your feathers, bad things happen. So obviously everybody has an opinion on whether or not stops are good, but years of experience watching the markets has led me to the conclusion that stops are probably more detrimental to traders in the long run than helpful. And the reason I say this is people they want to limit their risk. I mean, that's the idea of a stop loss order, and that's great. But they may want to limit their risk to $50 a trade or $100 a trade or whatever it is, this arbitrary amount. And so they end up losing small amounts on a high number of trades. For example, they might lose 50 to 100 bucks on 9 or 10 trades in a row because they have their stop too tight. And that $50 to $100 can add up pretty quickly. So there's a few things that you can do. If it's not possible, if you're the type that has to have a stop or has to have some sort of risk management tool in, I get it. I totally do. There's a few things you could do to mitigate the impact of trading without a stop, and that's simply using smaller contracts. This may not apply necessarily to day traders, but like mini grains, mini gold, e-micro gold, currencies, those sorts of things. You can day trade them, but it takes a big move for them to turn into anything profit and loss wise. You could buy weekly options to protect your futures positions, and that's what we're going to talk about in just a few minutes. Or you could just buy outright options, of course, but that's not what we're here to talk about today. So again, just to make sure you understand, the problem with involuntary liquidation at the hands of a stop order is it's impossible to recover. Once the damage is done, it's done. There's not much you can do about it. I don't know if any of you were trading last night during the presidential election, but it was hairy. I can tell you it probably made some traders, it probably made their dreams come true. And in other traders, it probably was their worst nightmare. And there's probably really not much in between. And I can guarantee you that there were a lot of people stopped out on trades that they were actually right on. For example, when the market sold off sharply because it looked like Donald Trump was going to win, anyone that tried to buy in would have had to have either been extremely lucky to have hit the low and not had their stop hit, or they simply bought in with no stop and were willing to cowboy it. They might have done well, but anyone trading with stops might have had a really, really hard time in an environment like that, and the losses could have been really big. And then the frustration could have been pretty substantial also, watching the market go in the direction you thought it was going to go, but without you. Ironically, traders are prone to exit losing trades at precisely the worst time. Exactly when we hit our pain threshold is generally when the market's about to turn around. This is known as puking long positions on the low and being squeezed out of shorts on the high. You always hear about the short squeeze. Well, that's exactly what's happening. In a short squeeze, generally the buyers aren't traders looking to get in to get long. They're generally traders that are short and trying to get out. So a way to avoid the idea or the probability of being either stopped out prematurely or puking out your long position on the low or being squeezed out on the high is using using options instead of stop loss orders. It provides lasting power. So you're going to get the limited risk and you're going to get lasting power. In a situation like yesterday, you could have put the trade on, and sure, it might have gone against you, but you knew that no matter what happened, if the S&P went to zero, your trade would still be valid. So if and when it did recover, you'd still be in. Now, had I known we would have had the election night fireworks, I would have created a different slide. I would have used a slide from last night, and we would have showed basically the same thing. We saw almost exactly the same pattern during Brexit earlier this year, which is what this chart is. But imagine being stopped out of a short futures position on the Thursday night before the Brexit vote or the Tuesday night before the election results, and then seeing the S&P drop 100 to 120 points after you were stopped out. And we all know that chasing the market lower normally doesn't work out. In these situations, it would have worked out nicely. But we're talking about how often do these type of things happen? Once every couple of years, maybe? So the odds are not with a trader that would have gotten stopped out at the high and then tried to chase the market lower. So that's more of an exception than a rule. But you get the idea. If you had lasting power and you could, other than, obviously the other way to do it would be to just cowboy it, sell the future, and if the S&P goes against you 10, 20 handles, just write it out. But the problem is you never know if you're writing it out for something better to happen or if you're just dead wrong. That's the hard part. But with options, you don't have to know. You know your risk, you have your protection in place, and if it doesn't work out, you lost money, but you were always in this situation where it could get better. So let's talk a little bit about that. Options are great day trading tools. I know most people don't think of options as a day trading tool, but they can be, trust me, especially now that the Chicago Mercantile Exchange offers weekly options. There's actually weekly options in most of the commodity markets, but the most popular are in the E-mini S&P. And so basically what that means is there are options expiring every Friday. And believe it or not, there's now actually weekly Wednesday options, which is, honestly, it's maybe a little insane. But what that means to us is there's options expiring on Wednesday and Friday of every single week. So when you're looking for an option to hedge your risk, there's always going to be something cheap available because there's always going to be something that expires in a day or two. So as we get into option trading discussions, let's just think of this. Logic will get you from A to B, but imagination will take you everywhere. And that's how I look at futures trading with stops versus option trade or futures trading with options. Takes a little imagination, but once you get the hang of it, I think you'll find that it really does give you much better odds of success. Sorry, I almost skipped a slide. So we just kind of mentioned this. Weekly options, particularly in the ES and the E-mini S&P, are now available by the CME. And they make it extremely affordable for futures traders to hedge their futures positions with options. If we would have had this discussion a few years ago, it would have been a much different discussion. Because at that point, options in the S&P expired every month, the third Friday of every month, but not every week. So there would have been really great opportunities to use options as hedging tools like the week of expiration, so maybe the third week of the month. But any other week of the month, we'd be forced to either buy really expensive options to hedge or to use stops, which is what most people did. So perhaps maybe the fact that people don't use options to hedge has a lot to do with the fact that weekly options really weren't available a couple of years ago, and now they are. And it's maybe taken a little bit of time for people just to catch on to the new opportunity. So obviously, let's just recap the advantages and disadvantages of selling a futures contract outright, because I know that's what most people do. If they think the market's going down, they sell a futures contract, and then they place a stop. The problem with that is, well, I should say the great thing about that is, as we all know, it offers traders an efficient, quick, and easy way to gain exposure to the market. There's immediate results. As soon as you're in, you're seeing P&L. It's exciting. There's unlimited profit potential. It's highly leveraged, especially in the futures market. And you get pure price changes. For every point the S&P goes in the direction you thought it was going to go, you make a full point, or 50 bucks. The bad side of that is there's no room for error. And I don't know about you, but I need plenty of room for error. I've been doing this for a long time, but I don't have a crystal ball. None of us do. And ultimately, we really have no idea where the market's going to go. We have our trading methodology in place and we've done our homework and we think we know where it's going to go, but we don't. So if you're trading futures outright, you have very little room for error, but using options along with your futures gives you a much bigger area to be wrong. In fact, there are certain strategies where you can be really wrong and still only lose a little bit of money. Or if you get into some more advanced strategies, there's actually ways where you can be really wrong and still maybe even make money. I know futures traders just do not have that luxury. They have to be precise. So let's talk about a strategy that's called a synthetic put. It's basically, in English, it's basically selling a futures contract and then buying a call option. It's called a synthetic put because the payout of that particular trade is pretty similar to just buying a put. So people might wonder, why don't you just buy a put? Well, the reality is the futures contract is more liquid. It's going to move quicker. And especially if the move happens overnight, such as last night, in the middle of the night, the options weren't necessarily as liquid as they might be during the day session. You could have exited the option, but the bid-ask spread was wide. A futures contract, we all know you just click a button and you're instantly out, and the fill is usually really efficient. Even last night, when things were crazy, the fills were efficient in the futures market. And the nice thing about doing it as a synthetic is you have the ability to adjust. If you sell your futures contract, you buy your call option, and you're right, and the market goes down, you can always buy your futures contract back, you offset it, you take your profit, hold on to the call. If you think the market's going to rebound, you can hold on to the call and then try to sell the call at a profit or at least closer to break even. Or you could even use that same call option as insurance for your next trade. So if you exit your short trade and the market bounces back, you might want to sell the future again and use the same call as your insurance going forward. Now, of course, I'm telling you all of these advantages of buying an option instead of placing a stop. But of course, it's not free. Insurance isn't free. That's basically what we're doing. We're selling a futures contract and we're buying insurance against being wrong. And that's going to cost us. So that's the idea of going with the short-dated options, the ones that expire soon because they will be a lot cheaper. And the downside of that is they will also erode pretty quickly. If the market trades sideways, we're not necessarily wrong, but we're not right either, that option will erode. So another obstacle of buying an option as your protection or as your insurance is before you can make money, you have to overcome the premium paid. So unlike a futures trader that just sells a future and places a stop, he makes money every point that the S&P goes down. A trader using an option versus a stop first has to recover the money that he's losing on the option, or at least the money he paid for the option, before he's actually turning a profit. So it's a cost. If the options are expensive, it's probably a cost that's not worth taking. But let's take a look at an example so you kind of understand what I'm talking about here. So a trader that's looking to sell the E-mini S&P due to an overheated oscillator, this is a pretty simplistic example, but this trader sees that the RSI is overbought, and so he decides it's time to sell. So this trader could sell a futures contract and then buy a call option to create limited risk and lasting power. So let's just take a look at the next slide here. Whoops. I'm going to skip that slide, sorry. Okay, so let's assume that the futures price is at 20.56, and we're going to go with the week 1 options. Just as an FYI, so you understand what I'm talking about, I mentioned that there's options that expire each week, each Friday, and actually each Wednesday, but we'll just ignore that for now. Each Friday, of the month. So the options that expire on the first Friday are week 1, the options that expire on the second are week 2, and so on and so forth. So this would be buying a week 1 option that happens to expire in 3 days. The futures market is at 2056, so this trader would be buying a 2055 call. The total cost of the option is $550 or 11 points. You'll notice that that call is 1 point in the money, right? Because we are selling at 56 and the strike price is 55. So our total risk is actually 11 points, even though we're paying 12 for the option. Now, to be honest, that's probably a little on the high side as far as price, because obviously $550 to hedge the risk of a day trade is maybe a little bit steep. Depends on your time horizon. If you're a scalper, that's probably just blows out the strategy and it's not attractive anymore. If you're somebody that's day trading, kind of day and swing trading, where you hold a trade maybe throughout the day, and if it doesn't work out, maybe hold it into the next trading session, it might be worth it. You know, if you're hanging on to a day or two, it might be worth it. This is just an example. If you are trading in low volatility markets, or if you're using options that expire in less than 3 days, let's say 1 or 2 days, you can find really cheap insurance. Like on the day of expiration, sometimes the insurance would only cost you $3 or $4 in the S&P, and we all know the S&P can move $3 or $4 pretty easily. So it just depends on the environment. But I'm just trying to give you an idea of the strategy in general. So this is what a payoff diagram would look like. A trader that went short the future at 2056, and then buying a 2055 call for 12 points. Hold on a second here. I'm not sure why the arrow is not pointing in the right direction, but let's look at this green arrow is really more realistic. So if we're selling it at 56, this is this general area right here where the green arrow is pointing. In order for us to make money, we have to recoup the premium that we just paid for the option, for our insurance. So the market has to get here, which is 2044, because we paid 12 points for the option. The beauty of this is, though, you can ride anything out. The most you could ever lose on this trade, no matter what happens, is the $550. So let's say the S&P does something really crazy and it goes up to 2120, or heck, it could go to 2200. You're obviously still losing money. You're going to be facing your maximum risk of $550, but you're in a situation where things cannot get any worse. They can only get better. You're still in the trade. It can come back, and that's dramatically different than a futures trader's risk. Futures trader would have been stopped out, hopefully. Hopefully they didn't ride it all the way up. And then they'd be wondering where to get back in, and then they'd probably stay on the sidelines and end up missing the move if it did happen. But a trader using this option instead of a stop doesn't care if the market goes to 2060, 2070, 2080, heck, it can go to 2120. Their risk is still $550, but they know it can come back. And we know in extreme situations, like we saw yesterday, the market can come back. We've seen, I mean, even in this situation, the Brexit, you know, somebody that sold somewhere in the 2040 area could have ridden it up to 2060 before it came back down and went their way. So you can see how this type of strategy gives people the lasting power to ride things out where simply trading futures outright with stops might not enable them to do. So another thing I just want to run by everybody is understanding day trading margin. And I know this sounds super simple and you're probably thinking, why am I wasting your time? But trust me, it is important, and most people don't really quite understand how it works. And as a broker, I can explain to you some of the nuances that might help you with making your trading decisions. Actually, I'm noticing a couple of questions about the options. Let me just answer those real quick. Keith is asking, could you sell a put instead of buying a call for this method? And the answer is yes, absolutely. Basically what you're talking about is similar to a covered call or a covered put, where you sell the futures contract and then you sell a put to bring in premium. If you're going to do that, you probably don't want to use the weekly options. You can, but just make sure you have you're using options that have enough premium to make it worth your while. That's actually a pretty good strategy. I'm a big fan of it because it gives you a big cushion for being wrong. Any premium that you collect cushions your upside risk. So if you're shorting the future and you collect 10 points on an S&P put, the futures market can go up 10 points and you're basically just relatively breaking even at expiration because the loss on your future is being offset by the gain on your short put. If the market goes down, your future contract goes below the strike price of your put, the option is in the money, but you really don't care because the profits on your future is making up for any losses on the options, yet you still get to keep the premium you collected, so it's a win-win. Somebody's asking if we've tried to do this with Nadex. Honestly, no. We're a futures and options brokerage, so we really only deal with futures. We don't do anything with equities. Someone's asking if you could do it with crude oil. Yes, if you can find the cheap enough margins to do it with crude. Crude options sometimes can get pretty pricey, so it depends on the situation. But if you can find affordable options, yes, absolutely. Okay, somebody's asking. Someone's asking to explain how let's go back to the previous slide here. So somebody's asking, as the futures price goes up, you're losing on the futures contract, so that's obvious, but your option is in the money. So at that point, your long call option is covering you point for point. So every point that the futures goes above your entry price of 2060, your option is making a point. So you're losing on the future, but you're making it back on the option. So you're basically just breaking even. So your total cost and risk is the cost of that option. So hopefully that explains that. Somebody's asking if it helps to use a call option that's further in the money. Some traders do that. I'm not a big fan of doing that, and the reason being the futures market will have to move further for you to actually start making money. That's one. And two, when you start getting options that are deep in the money, they start to get illiquid. Excuse me. So when they start to become illiquid, as they get deeper in the money, the bid-ask spreads get wider, and so your transaction efficiency really goes down. And I mean, you'd be surprised if you start getting deep in the money options, the bid-ask spread can be a couple $100 in some markets, so you want to be careful with that. And yes, someone's asking what's the relationship between a future and an option. Is it 1-to-1? And yes, it is. You would be doing 1-to-1 with a strategy like this. You could try, like if you don't want to have a perfect insurance policy, you just want to hedge, you could do like 2 futures to 1 call, but it's not going to be, it wouldn't be limited risk, it would just be reduced risk if you did anything other than 1-to-1. Okay, someone's saying they trade 50 lots at a time, 50 lots a day. If you're doing something with a very short-term horizon, you know, we're talking like a few minutes to an hour, it might be really tough for you to hedge with options. What you may want to do is, if you're the type that's scalping or play like range trading, swing trading, you could just buy options on both sides of the range so that you have some sort of insurance policy just in case the market really goes crazy and takes off. But it would be the more frequent that you're trading, and I should just say the more frequent you're trading and the lower profit potential you're looking for, the harder it becomes to use options as a hedge. So I'm going to come back and answer all of these questions, but let me just get through the last couple slides here. Okay, so day trading margin. Most of you may know this or may not, but intraday margins are actually set at the brokerage level, not the exchange level. So if you hold positions overnight, the exchange is telling your broker how much money you have to have in your account. If you are day trading, your broker tells you how much money you have in your account. So that's really the difference. Brokerage firms make a living on commission, so they like to entice people to trade with low margin rates. You'll see some brokerage firms out there advertise $300 to $500 per E-mini S&P, but you have to really be careful. I mean, just as for full disclosure, our brokerage firm does offer $500 margins on the E-minis, so we do it too, but I really recommend that traders don't use that type of leverage. It's really just not in their best interest. And another thing to keep in mind is when brokers do offer you the $500 margin rates for the E-mini S&P, not only is the leverage just unbelievable and you're probably going to lose money, it's a little bit of smoke and mirrors tactics. Most brokerage firms will liquidate your account if you dip to 250. So let's just, to keep it simple, let's assume you had $500 in your account and you went long an E-mini S&P. If you lost 5 handles on the S&P, they would jump in and liquidate you, and they're probably going to charge you some fees for it. And honestly, it's just kind of a big mess. It's not in your best interest to use those kinds of margins, but they are there. So the point is, don't choose a brokerage firm just because they have the lowest margin rates, because for starters, it's probably a little bit of bait and switch. And second, all they're doing is luring you in to trade more. They're there to make commission. They want you to trade more. They don't care if you lose money. And honestly, they're just kind of encouraging self-inflicted wounds. So the one thing that most people, even day traders that have been trading for a long time, for years, don't really understand is that margin is only calculated by the exchange at the close. You have to be out by the close. It's your responsibility to know when the closing time of the product you're trading is. If you're trading corn, it's a lot different than the E-mini S&P, and that's even different than crude oil or gold. So if you do not have the exchange required margin to hold overnight positions, don't do it. Doing it will obviously trigger a margin call. So one thing to keep in mind also as you're shopping for a broker, there's something to ask is whether or not they grant day trading margins overnight. Most discount brokers do not. Most discount brokers will give you day trading margins during the official day session. So in the E-mini S&P, that's like 8:30 a.m. Central Time to 3:15 Central Time or 4 o'clock Central Time, depending on which close you're going off of. And anything in between that or overnight is usually full margin, which in the E-mini S&P is roughly $5,000. So your margin goes from $500 for day trading to $5,000 if you hold it beyond the close. Our brokerage firm actually offers discounted margin around the clock, but keep this in mind: the exchange measures their margin exactly at the close. So the market's only closed for an hour a day. If you enter, let's say, I don't know, I know you guys are all in different time zones, so I'll try to keep it simple. But if you're, let's say that you're trading the E-mini S&P, the market opens at, I guess it's 5 o'clock, so 5 p.m. Central Time in the afternoon. So we'll just say today. Today is what? Wednesday. So it'll open up at 5 p.m. on Wednesday afternoon, and then it's going to trade all the way around the clock and then close at 4 p.m. on Thursday afternoon. So it's trading basically 23 hours a day. As a day trader, if you put your trade on the 5 o'clock open in the afternoon, and you held it all the way overnight and through the next morning and then to the next close, as long as you got out by the 4 p.m. close, that's a day trade. So you're only charged the day trading margin for that entire 23-hour period. So that's just a little trick. So anyway, another thing that you're going to want to do is make sure that keeping your account well funded gives you the ability to responsibly hold beyond the close. I know a lot of traders that have a system in place, a day trading system, a technical analysis system, but they automatically exit their positions at the close, which is great because I get it. That's the whole idea of day trading. You want to be flat so you can sleep at night. But to be honest, your technical analysis system doesn't care if you have to be flat or not. It doesn't care when the market closes. Your signals are going to play out. Even though the market closes and then reopens an hour later, they'll continue to play out when the market reopens. So you're really doing yourself a disservice if you have to get out at the close, as opposed to being able to fund the account enough to where you have the margin to hold into the next session. I'm not saying you have to go to bed with positions on, but you can get out of it a couple hours later in the overnight session. So I like to remind people that when they're talking about day trading margins and they think that they should only pick a broker that offers the lowest discounted day trading margins, just keep in mind, again, they're doing it to create higher trading volume, but the exchange determines the overnight margin rate based on the possible daily price fluctuation. In the E-mini S&P, the margin's usually anywhere between 4,000 and 6,000. Right now, it's roughly 5,000. So if the exchange thinks that you should have 5,000 in the account to cushion the possible daily price fluctuation, then it really doesn't make sense to try to trade that product on $500 if they think it could possibly move $5,000 worth. So just something to keep in mind. And I'm going to talk about one more thing that's probably not anybody's favorite topic, but we're going to talk about commission. And again, as you know, I'm a broker, so keep in mind my opinion is biased, but I really see a lot of traders, honestly, they lose a lot of money unnecessarily because when they choose a broker, and I'm not, you don't have to choose us as your broker. You can shop around and find the best fit for you, but I really want to make sure you understand. Commission matters, but it does not matter as much as you think it does. And it doesn't matter in the way you think that it does. Most people believe that they need to get the cheapest commission no matter what. But when you really do get what you pay for. When you're paying a very low commission rate, you're probably going to get very little service. You may not have a 24-hour trade desk, and if something goes wrong, you're just out of luck. You may not have timely and efficient email service or phone access to somebody if something goes wrong, and that alone can cost you hundreds of dollars in the market. They may not give you overnight day trading margin. They may force liquidate your account at the earliest sign of distress. They might close all of your positions on the close of trade no matter what, whether you have enough margin in the account or not. So there's all of these things that deep discount brokers do to account for the fact that they're not charging any commission. So you get what you pay for. And you also need to think about 1 point in the E-mini S&P is $50. 1 point in the 30-year Treasury bond is $31. 1 tick in crude oil is $10. So do you really think that an extra buck or two in commission is going to decide success or failure? The honest truth is it really doesn't. There's so many other things that determine whether or not you make money that is actually on the bottom of the list. Unless you're a high volume scalping trader, then that's a different story. So, obviously you just have to determine for your personal situation what is the best arrangement, but just don't fall into the trap of thinking cheapest is the best, because it's not. When you go to buy a car, are you thinking the cheapest is the best? Not necessarily. If you're going out to dinner, you don't think cheapest is the best. You think you're looking for the best value. You want high quality at a fair price. Commission is the same. The other problem with low commissions, and I'm talking super low commissions where it's just the brokerage makes nothing. Because they're making nothing, they're not going to give you anything in return. But the other side of that, the flip side is people that are paying super discount commissions, they feel like they have the freedom to trade. They think, well, I can trade, it's not costing me much, so I might as well just click the button and sell. But it leads to traders selling in very high quantities, or buying or selling. It leads to self-destruction. Just because you feel like you can, because it's not going to cost you much in commission, doesn't mean you should. Market losses can way overshadow any commission you ever pay. So don't focus on rate, focus on behavior. And also, really, the reality is the true cost of trading depends on your behavior as a trader. You don't have to trade 100 contracts at a time. You could trade a couple, maybe one. If you really want to save money, trade less. Higher volume is going to lower your odds of success, and it's going to increase your transaction cost. So the best way to trade to save money on commission is to trade less, and I guarantee you're going to have better odds in your trading. Okay, I forgot I put this slide in here, but the idea is the goal is to make money, it's not to save it. If being with a reputable broker saves you one tick in the fill price, every once in a while you're ahead. A good broker will give you market guidance, they'll give you quicker tech support, they're not going to be as quick to force liquidate your account, they're going to give you better customer service, and they probably have lower account minimums. Okay, so as a reminder, if you're interested in trading commodities or anything that maybe we talked about today or a lot more, check out my new book. It's Higher Probability Commodity Trading. And we appreciate you coming out. I hope that you learned something. I hope you got something out of it. Feel free to visit our website. And if you have any questions or anything, feel free to give me a call or send me an email. I'm going to go ahead and go through all these questions that I haven't answered here. See if I can catch up. Okay, so, Greg's asking what's the minimum time frame to making using options feasible, 1 day or greater. You know, it really depends on option pricing, and option pricing is cheaper when the markets are quiet and when there's less time to expiration. So there's not really a good answer to that, other than I would say you're probably okay using options as a hedge anywhere from a half a day to 2 or 3 days. If you're trading and you're only in the market for an hour or two, that may not be enough market movement for you to justify using an option hedge. And someone's asking if there's slippage on the options. There's not really slippage, but it's not like futures. Futures are extremely liquid. You can buy or sell at the market with even the S&P, the bid-ask spread is about a quarter of a point. In the options, it's about a half a point. So it is a little thicker on the bid-ask spread, but it's definitely tradable. I don't think you're going to find that your transaction slippage is going to be that substantial unless you're trying to get in or out of an option in the overnight market. It's a little wider at that point. Somebody's asking in that example that we were showing how many futures contracts were covering for the hypothetical risk of $550. That was using one futures contract and one option. Like I'd mentioned, that option had 3 days to expiration. So that option would have insured the trade for 3 days. If you had found an option that expired in 1 day or 2 days, it would have been a lot cheaper than that. I know that sometimes if there's options you can find the day before expiration for like anywhere from, depending on volatility, anywhere from $4 to $6. So $200 to $300 could protect you for a day and a half or so in the markets, and that's a pretty good deal. The S&P, you can generally, I'm not saying always, but you can usually catch a 2-3 handle move pretty easily, and then ideally if you're doing, using the option hedge, you would need to catch more like maybe 6 or 7 to make it worth your while. Someone's asking if, okay, I should have mentioned the margin on these futures and options hedge. So like if you bought or sold a futures contract and then you purchased an option to protect that, there really is very little margin at all because your risk is limited. It's almost like buying an option. If you sold an option against a futures contract as your hedge, does require a margin requirement. So like if you held overnight, there would be a margin on it. It's generally about half of the overnight margin. So in the S&P, you're talking about $2,500. So it can be pretty steep margin-wise if you're holding like that. Okay, someone's saying that if you're, we're talking about the ratio of 1-to-1, you're trading one futures contract versus one option. And if you do that, isn't your delta 50%, which means wouldn't, oops, sorry about that. So anyway, your delta would be 50%, you're absolutely right. So as the futures price goes up, you're losing 1 point on the future and you're making 1 point on the option. So that is true in the short run. But if you hold it all the way to expiration, the option comes into line with the futures. So if you hold it all the way to expiration, the option will cover you with a delta of 1, and your futures is a delta of 1. So it ends up washing out. If you exit the option before expiration, then yes, it is possible that your option makes less than your futures market, your futures position lost. Okay, someone's asking how you establish that type of a position. Can you do it in a single ticket? And the answer is no. You would actually do it completely separately. So you would enter the futures contract in your dome panel or using Jigsaw or whatever it is that you're trading on, and then you would enter the option in the same platform, ideally, if possible, but using an order entry ticket, depending on the platform you're using. But it would be on 2 separate tickets, so it wouldn't be a package deal. And someone's asking if this would apply to portfolio margining, and the answer is yes. In the futures and options markets, at least here in the U.S., any futures and options account automatically gets portfolio margining. So regardless of how big your account is or what your volume is or anything like that, if you are trading options and futures together, you get portfolio margining. And the exchange basically assesses your risk according to the positions in your account. So they account for all your positions, your long options, your short options, your futures, and they meld those together and they come up with a number. The margin is different for options on futures as it is options. It's actually quite complicated. Option margin is based on a calculation, it's called span, and it actually fluctuates throughout the day, believe it or not. So it's a little bit wild, but the rule of thumb is option margin is generally about half of the overnight futures margin. Okay, somebody's asking if they can demo our trading platform. Yes, you can sign up for a demo of the Zaner 360, which is compatible with Jigsaw on our website. It's decarleytrading.com. It's right here on the slide. Recommended minimum balance, if you do decide to trade with us, we really don't have a minimum balance, but if you're looking to trade futures versus options, I would say you probably at least want to try 5,000 or more. Somebody's asking how large of an ES target justifies using options to protect it. I would say if you're trying to get anywhere from 5 to 10 handles, I think it might be worth it, again, depending on if you can find a cheap enough option. Remember, you can recycle options. So if you use a call option for one trade and the market bounces back, you can use the same call for another, and so on and so forth. So it's not, you know, it's a little bit proactive as far as trading, but okay, someone's asking, do you try to liquidate the option prior to expiration? In this particular strategy, the idea is that option is it's your insurance policy against something going wrong in the futures position. So I would recommend in most scenarios, yes, exit the option before expiration. You don't want it to expire worthless. If it expires worthless, you lose all the premium that you paid for it. But it's situational. If you exit the futures contract and you believe that the market will reverse and your option could come back into play and maybe become profitable, then hang on to it. So again, be creative, and there's no hard and fast rules. Just do what you think makes the most sense based on the current market conditions. Somebody's asking about displaying the book again. Sure. Okay, somebody's asking if I know if Thinkorswim or Ninja allows futures and options together on the same platform. I mean, they are our competition, but I do happen to know that Ninja does not offer options within the same platform. Thinkorswim does. Thinkorswim is more of a stock broker than a commodity broker, so they have some challenges when it comes to options on futures, but that's a whole nother story. They do have both futures and options in their platform. Somebody's asking, can you trade CME options 23 hours a day? Yes, you absolutely can. There's a few things to keep in mind, though. The liquidity isn't always ideal, and it depends on the market. If you're talking about gold options or crude oil options, the option markets are open, but they're not necessarily extremely liquid 24 hours a day. They get a little thin at night. In fact, there's times that there are no market makers, and so they're open, but they're not really tradable. Markets that are quite a bit more liquid, like the treasuries, the currencies, or the stock indices, the option markets are open 23 hours a day along with the futures markets, and they are pretty liquid the entire time. Okay, someone's asking, did I cover long options because I prefer that approach to short options? Not necessarily. For day traders, I think long options is probably a better bet. For position traders or those willing to hold on a little longer, I think short options is probably a better bet to hedge your futures positions. All right, Kyle's asking if you could structure a collar with futures, which basically means you buy a put, you buy the futures contracts, the ES, and then you sell a call against it. And yeah, you could absolutely do that. You probably wouldn't be able to do that with weekly options. I don't think you'd get enough premium to make it worth your while. Collars are a great strategy. They're very low risk, but they're also very low profit potential because by nature, there's three legs and they're all kind of hedging each other in one way or another. But yeah, it's definitely possible, but you'd need to go out with a longer time frame. It wouldn't be, for day trading, it wouldn't work. Someone's asking about the crude oil hours. Crude oil generally trades about 24 hours a day. I mean, it's similar to the S&P. It's actually 23 hours a day, but it is around the clock, nonstop it actually opens on Sunday afternoon in the U.S. and then trades all the way to Friday afternoon. So as a broker, it requires long hours. The mini Dow is the same. It's basically 24 hours a day. It opens on Sunday afternoon, and then it closes on Friday afternoon. Yes, higher probability commodity trading is available on Kindle. Someone's asking if you sell a futures contract and then you buy a call option for your insurance and the market sells off, you take a profit on your future. Well, how much money have you lost on the option? And that's a good question. It depends on how long, or how long it took the market to sell off, how fast it did it. So the thing about option trading is it's not as simple as futures trading. It's not necessarily, it's not feasible to predict, or I guess it's not possible to predict exactly what the option value will be at a certain point in time, because option value is based on demand, volatility, time. So there's all these things that come into play. But generally speaking, I would say you're probably going to lose anywhere from 30% to 50% of the option value on a typical move. If you put your option hedge on and the market just completely crashes, it's good news because you're making money on your futures, but your option's probably going to be basically worthless at that point. All right, some of you are asking commission questions. Our commission is based on volume and risk and account size and that sort of thing. If you shoot me an email with just the basic information about yourself or your trading account, I'll be able to give you a precise quote. My email address is cgarner@decarleytrading.com. Someone's asking, please list the advantages of using a futures contract with an option as opposed to just trading the futures outright. And okay, I'm sorry, I take that back. They're saying, what's the advantage of trading a short futures contract and a long call as opposed to just buying a put outright? And the advantage is you have the ability to adjust. For example, if you put the trade on and the market goes against you and your call option's paying off. Let's say you're making money on your call option, but you're losing on your futures contract, but you still believe the market's going to go down. You can take a profit on your call and hold on to the short futures contract. And vice versa. If you put the trade on and the market goes down, you can take a profit on your futures contract and then hold on to your call and try to resell it on a bounce. So there's that ability to adjust, and also there's the ability to exit efficiently and quickly if something really crazy happens. Because the idea about, we were talking about last night, some of the options weren't as easy to trade. The bid-ask spreads were wide and that sort of thing because the volatility was big and it was occurring at a time that the markets were not necessarily extremely liquid. So somebody that had a put option might not have been able to get out of the market with as much profit as he thought he deserved, whereas somebody that had the long call and the short futures could have very efficiently exited their futures contract and then gone from there. Okay, I think I've answered all of them. If I missed any, I deeply apologize. Send me an email or give me a call and we'll make sure we get everything taken care of for you.
Okay, thank you, Carly. That was a great presentation. Certainly given me something to think about, and I know it's a topic that many of our traders are interested in. There's going to be a recording of this event for those who want to watch it again. Give me a couple of days to get onto YouTube. I will send an email out. But once again, thank you very much, Carly.
You're welcome. Thank you.
Okay, and thank you all for turning up.